Welcome! Today, we're diving into the latest financial results for Singapore Land Group. And at first glance, these numbers seem to tell two completely different stories. Revenue is up, which sounds great, right? But then you see that profit is down. So what's really going on here? Let's dig in and find out.
Yeah, financial reports can sometimes feel like they're designed to leave you scratching your head. A number goes up over here, another one goes down over there, and the real story, well, it can get lost in all the jargon. And that's exactly the kind of puzzle we're going to unpack today with Singapore Land Group.
So here it is, the central puzzle we need to solve. How can a company's performance be both positive and negative at the exact same time? It sounds kind of contradictory, but the answer is fascinating. It really lies in the difference between the actual cash a company earns and what its assets are worth on paper.
Okay, let's put some real numbers to this. Take a look at the headline figures. Revenue, that's the total money coming into the business, is up a really solid 7% to over $783 million. Awesome. But then you look at the bottom line, the actual net profit, and it's down 4%. So more money came in the door, but less of it actually ended up as profit. How is that even possible?
To figure that out, we first need to understand the good news. Let's not get ahead of ourselves. Where did that 7% revenue growth actually come from? For that, we need to pop the hood and look at the engine room of the company.
And wow, the main driver is immediately clear. Just look at that bar for property investments. This one segment brought in over $333 million, and get this, it grew by a massive 22% in just 1 year. This was the powerhouse, no doubt about it, that lifted the company's entire revenue.
Exactly. And this growth wasn't an accident or just a lucky break. It came from some really smart, strategic moves. We're talking about a major new acquisition in Sydney, plus much better performance from their upgraded properties right here in Singapore, like the Singapore Land Tower and West Mall.
Okay, so the revenue story is crystal clear. The core property business is performing really well. Now let's get to the main event, solving that profit puzzle. Why on earth did the bottom line shrink when the top line grew so nicely? Well, to find the answer, we have to look beyond the headlines.
First, let's quickly decode some of that jargon. You see the term PATMI on the slide? It's a bit of a mouthful, but all you really need to remember is that it stands for the final bottom line profit, the end of the day number. And that's the number that was down 4%.
Right. And to understand PATMI, we have to talk about another key concept, fair value gains. This really gets to the heart of the difference between real cash and on-paper profit. Think of it like your house. If its market value goes up, you're technically wealthier on paper. But it's not like you suddenly have that extra cash in your bank account, right? For a big property company, these on-paper gains are huge, and they can swing wildly from year to year.
And here it is. This is the aha moment that cracks the whole puzzle wide open. The headline profit, that PATMI number, was down 4%. But if you strip out those on-paper fair value gains and just look at the profit from the core business operations, it was actually up by a very, very healthy 16%.
That's the real story right there. The core business is strong. So why did the headline number fall? Well, the report tells us exactly why. Two main reasons. First, those on-paper property value gains were just smaller this year than they were last year. And second, there was a small one-off foreign exchange loss. It was those two things, less paper profit and a small one-time hit, that made the headline number look weaker than the actual business performance.
So with a core business that's actually growing at a healthy 16%, what's the company doing with its money? Well, they're definitely not just sitting on it. They are actively reinvesting to fuel future growth.
And you can see this reinvestment strategy in action. I mean, they're making some big strategic moves here. They're acquiring a major stake in a prime Sydney office building, while also funding major redevelopment and enhancements at key properties in Singapore. They are absolutely putting their capital to work.
Of course, and we all know this, making big investments like these always comes with both opportunities and risks. It's two sides of the same coin. So for anyone looking at this company from an investor's perspective, it is absolutely crucial to understand both.
So what are the key factors to keep an eye on? Well, all this investment means higher borrowings. The gearing ratio, which is just a measure of debt, has more than doubled, and finance costs are rising. Plus, they've got a pretty significant chunk of debt to refinance soon. But on the other side of the ledger, the net asset value per share, a key measure of the company's underlying worth, is actually growing. So what's the takeaway here? The company is taking on more risk to fuel growth, but so far, that strategy seems to be increasing its fundamental value.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.